I'm planning on converting my seven-figure IRA to a Roth IRA over the next couple of years. That's how a post started in a Facebook group that I read recently, and it got me thinking, have we gotten carried away with Roth conversions? In addition to hundreds of thousands of dollars in extra taxable income for those years, there's a multitude of adverse side effects that can come with Roth IRAs that I don't think many people are aware of. So in this video, I'm going to cover several situations where a Roth conversion probably does not make sense, as well as several adverse side effects that come with them that not a lot of people know about. Hey everyone, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors. This channel and my firm are dedicated to giving you more confidence and clarity with your money. So before we get into it, let me be very clear. Roth conversions are an extremely powerful strategy to save thousands or even hundreds of thousands of dollars in taxes over the course of your lifetime if the situation is right. I use Roth conversions frequently in my own practice, so this video is not to say you should not do a Roth conversion, but rather help you understand that there's more to it than just your tax bracket now versus tax bracket later. And again, everything that we're going to discuss can be considered a situation where a Roth conversion probably does not make sense or an adverse side effect of a Roth conversion. So starting with number one, Roth conversions can have tax consequences beyond just your ordinary income or your federal income tax bracket. What I mean by this is it can affect your capital gains tax rate as well as net investment income tax that we'll talk about in just a moment. But starting with capital gains, if you're not familiar, in the US, there's basically two tax schedules that apply to most people. There's ordinary income and then there's capital gains income. Ordinary income is things like income from employment, withdrawals from IRAs, pensions, and Roth conversions. Capital gains is from the sale of an asset like a stock, a mutual fund, a business, or real estate, and that is the tax rate that you pay on the gain from selling that for more than you bought it for. Long-term capital gains typically have favorable rates over your ordinary income. It can be taxed as low as 0%, 15%, or 20%, and that rate depends on your adjusted gross income. Adjusted gross income includes your income from capital gains as well as other ordinary income. Important thing to note is that your capital gains income is stacked on top of your ordinary income when determining what rate you pay. So as you convert more money to Roth, it increases that ordinary income and pushes up that capital gains income potentially into a higher tax bracket. So let me show you what I mean with a quick example. All right, so here's what I mean when I say that capital gains income, and ordinary income is taxed at different rates. So this is the federal income tax schedule. Again, the more you make, the higher rate you pay. And then with long-term capital gains down here, you can see that you can earn basically up to $94,000 in adjusted gross income and pay 0% for capital gains taxes if it's long-term. After that, it goes up to 15% and then eventually 20% once your income is above that threshold. So let's take a look at two scenarios, one where there's a married couple living off of purely capital gains income, and another where they do a Roth conversion to show you the added side effect on their capital gains. So we're going to make a couple assumptions here. We have a married couple over the age of 65. They're currently retired and living off of nothing but long-term capital gains income in scenario one here. The second scenario is going to be where they're living off of that same amount of capital gains, but they do a Roth conversion of $100,000. So down here, we have their long-term capital gains in either scenario of $80,000. And then again, in scenario two, we have the Roth conversion of $100,000. So in scenario one, you can see their only income is $80,000. They pay $0 in taxes because they fall within that 0% long-term capital gains bracket. So even though their taxable income after deductions is $47,700, they fall well within this bracket and pay $0 in capital gains. In the second scenario, their total income is $180,000 from that $100,000 Roth conversion, but now they owe a total of $16,126 in taxes. And the reason for that, again, is because their ordinary income fills up from the bottom first. So after we subtract the standard deduction of $30,750 for a couple over 65 from their $100,000 Roth conversion, they're left with $69,250. But that pushes the rest of their income from capital gains up into a higher tax bracket. So now only $24,800 of their capital gains is taxed at 0%, and the other $55,200 is pushed up into that 15% tax bracket. So now instead of paying $0 on their capital gains, they're paying $8,280 in addition to the taxes that they're paying on their Roth conversion amount. So again, this is the example I was referring to when I say that your Roth conversions push your capital gains up potentially into a higher tax bracket. The other effect that Roth conversions can have is on the net investment income tax. So if you're married filing jointly and you earn over $250,000 in modified adjusted gross income, or $200,000 if you're single, you pay 3.8% on any dollars that you make over that. So again, when doing Roth conversions, you really have to consider your total effective tax rate when doing them. In other words, what tax rate you're going to owe on other income like capital gains and the net investment income tax to really determine whether or not it makes sense for you. So moving on to the first scenario where it may not make sense to do a Roth conversion is if you have to withhold taxes from the conversion amount itself rather than paying the taxes from another source like a bank account or a brokerage account. The reason it typically makes more sense to pay the taxes out of pocket rather than the withholding amount is because it allows more money to go into that Roth IRA and continue growing and compounding, ultimately resulting in a higher tax-free balance later on. So again, just a quick comparison to visualize this. If you convert $100,000 and you withhold taxes on it, let's say that you're in the 24% tax bracket, you're ultimately going to end up with about $76,000 going into that Roth IRA. We're going to assume that it grows for 15 years at 7% annually. That 76,000 would then become about 209,686. Whereas if you paid that $24,000 in taxes out of pocket, let's say from your savings account at your bank or a brokerage account, and you allowed the full $100,000 to go into the Roth IRA, over that same time period and same rate of return, you'd have over $275,000. So again, pretty significant difference by paying the taxes out of pocket rather than withholding. Where you pay the taxes will depend heavily on your personal situation. You definitely wouldn't want to say deplete your emergency fund just to pay the taxes out of pocket. So again, case by case basis for this one. I'll break up the next adverse side effect that Roth conversions can have into two parts, but they're both related to healthcare expenses. So number one being when you're already retired or age 65 or older and on Medicare. Since Roth conversions do increase your modified adjusted gross income, they can create what are called IRMA surcharges, which stands for Income Related Monthly Adjustment Amount. And that's essentially an additional premium that you pay for Medicare based on your income. It does have a 2-year look back period, so whatever you convert to Roth today is going to affect your surcharges 2 years into the future. By the way, as you can see, there's a ton of good information on this important number sheet. If you want to download a free copy of this, you can. I'll put a link in the description below. But for IRMA surcharges, again, just to give you an idea of what those are, you don't pay anything if you make under a certain amount, but as you make more, again, either from Roth conversions, other income sources, whatever it might be, this is the monthly amount that you pay for Part B and Part D. Not too crazy in the first tier, comes out to maybe $700-800 per year, but it starts to go up pretty drastically as you make more money. So definitely something to be mindful of when doing Roth conversions. Second part to this is if you plan to retire early and purchase a marketplace healthcare plan under the Affordable Care Act. By keeping your income low and using strategies like long-term capital gains, using money in a savings account, whatever it might be, to keep your taxable income low, you can qualify for the premium tax credit, which essentially is money that's reimbursed to you for healthcare. There is a lot of nuance to this that I won't go into too much detail on in this video, but essentially if you're anywhere between 100% and 400% of the federal poverty level, you qualify for assistance under the Affordable Care Act. Does depend on the size of your family as well. So again, a little bit of nuance to it, but the consensus is that the money that you receive in the form of a premium tax credit to pay for your healthcare is generally more valuable than the potential tax savings of a Roth conversion, even if it means higher RMDs later in life. So again, depends on your unique situation, but generally speaking, you may not want to do a Roth conversion if it means that you lose that healthcare subsidy in early retirement. Next situation where it probably doesn't make sense to do a Roth conversion is if your tax bracket today is higher than your expected tax bracket in the future. So this one's a little bit more obvious if you're already familiar with Roth conversions, but put some numbers on it. If you're a high income earner in the 32% tax bracket today, you wouldn't want to convert money to Roth, pay 32% when you could be withdrawing that money from a pre-tax account in the, say, 24% tax bracket anyway. A few other things that would fall into this same category would be if you plan to pass along a certain amount of money to your heirs and you want them to receive that tax-free, consider what their tax bracket would be relative to yours today when you're converting it. It may make more sense just to pass that money to them as a pre-tax IRA. Of course, there is something to be said about passing along tax-free money to your heirs if you don't want them to have to worry about that no matter what. And the fact that you don't have to take required minimum distributions over 10 years from Roth inherited IRAs. Obviously, those are other factors that play into it. Same thing goes for money that you plan to donate to charity either while you're alive or after you pass. There's no sense in converting that money to Roth, paying taxes on it, and ultimately having less money go to charity when they can receive it tax-free in the first place. And the last adverse side effect of Roth conversions is involving what's known as the Social Security tax torpedo. If you're not familiar, your Social Security benefits can be taxed depending on your provisional income, which is calculated as your adjusted gross income which includes Roth conversions, plus half of your Social Security benefit, plus any non-taxable interest like interest from municipal bonds. So the pulling back up our important numbers chart here, the Social Security tax torpedo refers to an additional dollar of income not only being taxed at your ordinary income tax rate, but also pulling an additional amount of Social Security into that taxable bucket as well. So, for example, if you're in this 85% taxable bracket, depending on your provisional income, and you convert one extra dollar to Roth, not only going to be taxed on that $1, you're going to be taxed on $1.85 that you're pulling into this bracket from Social Security as well. So definitely consider what your provisional income is going to be before doing a Roth conversion. So I hope you learned something new in this video. Again, there's a lot of moving pieces when it comes to Roth conversions beyond just what your tax bracket is now versus later. In fact, I recently did a video of a case study where a couple is projected to save over $1 million in taxes by doing Roth conversions. If you want to check out that video, here it is now. Other than that, thank you for watching and have a great day.